So here's the thing, right? You know that the trend is your friend, right? Traders have told you you should be trading with the trend. Trend trading is the real deal, right? This is how you know you make money in the markets. But if you look at the charts, right, the screen on my chart right now, you can see that this is an uptrend, okay? This second chart over here, it's a downtrend. And this third chart over here is another downtrend. And one thing that I want you to pay attention to is, again, look at the first chart again. Notice this over here has a shallow pullback. Second one over here, this chart has a much deeper pullback. Okay, deeper pullback, a deeper pullback over here. And finally, the third chart, you have even a deeper pullback over here. So here's the first secret, right, of trend trading. Not all trends are created equal, right? I do not know why traders don't talk about it. They talk as though trends, they're all the same, but it's not. They're not created equal. Right, and that's why in today's video, I want to share with you the 3 types of trend that every trader must know. Because if you do not know what are the type of trends out there, you can still lose money even though you're trading with the trend. So that's the first thing we'll cover. And then I'll share with you when is the optimal entry point, right, to enter a trending market, depending on what type of trend it is. And finally, by the end of this video, you will be a professional trend trader who can profit in the different types of trending market. Sounds good? Then let's begin. So firstly, right, the first type of trend that I want to share with you is what I call a strong trend. A strong trend, right, is when the trend is strong. Okay, so how do I actually define a strong trend? It's when the price, right, respects the 20 MA. So this over here is the 20 period moving average. And as you can see, the market remains below it. So this gives you a big clue, right, that this trend is actually strong, and that's why it has been consistently below the 20 MA. So how would you trade a strong trend? Ideally, right, you would want to trade a breakdown or a breakout. So in this case, since it's a downtrend, you want to trade the breakdown, right? A breakdown of this swing low over here, or even this swing low. Why do you want to trade a breakdown? Because in a strong trend, right, seldom, right, does it do a nice pullback for you to time your entry. Seldom does it retest a moving average. Seldom does it, retest, resistance. So if you look at this, right, it only tested the moving average over here once, and then over here it didn't test, here it didn't test. And if you were waiting for it to come to the moving average, if you're waiting for it to come to the previous swing high, you will be disappointed because the market, it's in a strong trend. That's why it doesn't have a deep retracement. So if you want to trade pullback or retest or key levels, again, you will be disappointed. That's why I say that, in a strong trend, it's ideal to trade breakouts or breakdowns. So in this case, you can just simply go short, right, when the market breaks below this swing low, or even this swing low over here. And to set your stop loss, right, ideally, you want to set it beyond the 20 MA. Don't just put it above the 20 MA, because what could happen is the price, you can see over here, it spike up higher and then collapse lower. So give it a distance, give it some buffer above the 20 period moving average, right? That is, I would say, ideal way to trade a strong trend, right? To trade the breakdown, okay, or a breakout if it's in an uptrend. So that's the first type of trend that I want to share with you. The second type of trend, right, that I want to share with you is this, right? Let's look at the Aussie dollar, okay? It's what I call a healthy trend. How do you know that a trend is healthy? All right, a healthy trend, right, usually has a clear pullback towards the 50 period moving average. So this means, right, that you can actually time your entry towards the 50 period moving average. If you look at this, right, over here, the market has tested the 50 MA once, twice, thrice, almost here 4 times and 5 times over here. So you can see that in a healthy trend, what you want to do is to wait for the market, be patient, and let it come back towards the moving average. In this case, this one over here, I used the 50 MA to define a healthy trend. So you can see that the price retests the 50 MA over here. We have a bearish engulfing, the price closed lower. This one, you have a shooting star pattern before, closing near the lows of the candle. So these are all entry points that you can use to trade in a healthy trend. And one tip that I want to share with you is that based on my years of trading trends, right, I realized that in a healthy trend, the market also tends to respect previous support turn resistance or previous resistance turn support. So if you see over here, right, this over here is previous support turn resistance, and over here previous support turn resistance. So you can see that on top of it, right, a confluence factor that you can look at is not only the 50 MA but also at previous support turn resistance, right? This is where there's a good chance of the market reversing in a healthy trend. And very simply, right, to time your entry, just wait for a reversal candlestick pattern, and you can time your entry. And again, you don't want to set your stop loss, right, just above the moving average. You can see that over here, right, price spiked through the moving average, then it collapsed lower. Give it some buffer, give it some distance away from it. You can use an indicator like the average true range, or just eyeball and give it some buffer, and maybe set your stop loss, right, somewhere about here, your stop loss somewhere here. Okay, so this is how you would go about trading the healthy trend. So what I don't recommend, right, in a healthy trend is that you don't necessarily want to trade breakouts over here. Why is that? Because if you look at this, right, in a healthy trend, the market tends to pull back towards a moving average. So if you were to trade, let's say for example, breakdown of this swing low, you can see that the market went slightly in your favor, and then you have to swallow this deep pullback against you. So in a healthy trend, this would happen often. If you were to, trade breakouts, you would have to endure quite a sharp pullback when it comes back towards the moving average. It doesn't happen often, right? But more often than not, it will do a pullback, like revert back towards the mean. So this is why I don't really recommend trading, breakdowns or breakout, or in a healthy trend. It's much better to, time your entry and wait for a pullback either towards the moving average or previous support and resistance. Okay, and moving on, right, the last type of trend that I want to talk about is the wick trend. So for example, a wick trend usually occurs, right, when the price doesn't respect the 50 period moving average anymore. It tends to exceed beyond it. So you can see it over here, right? This is the euro dollar. Price has been respecting the 50 MA, and then over here it trades beyond it, and over here it trades beyond it even furthermore. So how do you actually trade the wick trend? So this is where your support and resistance comes into play, right? For example, based on this chart over here, I identify that this is an area of resistance, right? So what I'll do is that I will now time my entry at resistance, since this is a downtrend. So price, right, came into this area of resistance, right? Shows price rejection over here. You have this dragonfly doji rejecting the highs. Then the next candle had a slight bull candle, and finally this third candle reversed lower towards the downside with a bearish close. So this is a sign of price rejection. And if you look at this, right, you can look to go short. Again, stop loss, right, set it a distance away from this high, somewhere about here. And this is how you can actually trade the wick trend when price comes towards an area of value like support or resistance. Okay, so just to do a quick recap, right? Trend trading secrets number 1. Strong trend, right? Price tends to respect the 20 MA. It's ideal to trade breakouts in a strong trend. Trend trading secret number 2. Healthy trend. The price tends to respect the 50 MA. This means that it won't exceed beyond it, right? And it's ideal to trade pullback towards the 50 MA or even previous support term resistance, and vice versa. And third thing, right, in a wick trend, the price tends to trade beyond the 50 MA, sometimes testing the 100 MA or even the 200 MA. In cases like this, it's ideal to trade pullback towards support or resistance. So now, just a additional quick tip to share with you, right? So the concept, right, of trading breakouts for the wick trend. Okay, wick trend, it's let's talk about the goal. Okay, goal is that although you are trading breakouts, okay, say for example the 20 MA over here, although you are trading breakouts, you want to use a little bit of a discretion over here. So it's the same thing as the healthy trend. If you notice that the price has already broken out, say over here, yes, Rayner said, to trade breakout, and if the market is really breaking out at this point over here, okay, are you sure that you still want to chase the market at this point, even though it's a strong trend, even though it's breaking down? Are you sure you still want to go short? Because if you think about this, right now, number 1, the price is very far away from this 20 MA. And if it decides to snap back, pull back towards the mean, like a rubber band, pull back towards the mean, you have to potentially endure that retracement. So is this a good trade that you want to take? I don't think so, right? I don't want to be trading when the price is so far away from the moving average. If you compare that, right, to this, let's say over here. Now, let's say over here. The market over here, if you were to go short, is much nearer towards the 20 MA. So even if the pullback were to come, right, you don't have to endure that much pain. Whereas you compare to this portion over here, this is a lot of distance that you have to endure as a pullback. So again, you want to watch where price is, right, relative to the moving average. If it's too far away, I usually, suggest, trader wait for the price to come to you. Okay, this is important. Okay, in this case, right, the market did a steep pullback, and right now it's just consolidating, near this around the 20 MA, whipping up and down. Okay, so that's the first tip that I want to share with you. And are you interested for an additional tip? Okay, let me share this with you, right? So what I've just shared with you as entry points is number one, we trade breakouts, and number two, we trade the pullback by using very basic reversal candlestick pattern. But what I want to share with you is more advanced stuff, right? And it's ideally for traders who have already been trading for at least a year or more. It's because you can actually use multiple time frame to time your entry. So let me share with you an example. Okay, so let's look at Aussie dollar. You know that it's in a healthy trend, right? Because I just shared that with you. Okay, so just pull out the 50 MA. And you see that Aussie dollar over here came into this area of value. Okay, this 50 MA. So one way you can go about it is that, traders, they can just go short based on this reversal candlestick pattern. Alternatively, right, if you want to, better time your entry, have a better risk to reward, you can go down to a lower time frame like the 4-hour and time your entry. And you see over here on the 4-hour time frame, notice, right, that the market has actually formed a, well, if you ignore this spike, right, this spike over here, pretty much you have a lower high and a lower low and a lower high over here. So at this point in time, right, when the market actually break and close below this swing low, you can go short. Okay, somewhere here, market break below this swing low, you go short over here and set your stop loss, right, just a distance away from this high, maybe just slightly above it. So instead of originally when you're trading off the daily candlestick pattern, the daily price action, your stop loss, right, would go a distance beyond this high. But right now, if you go down to the lower time frame, you can see that you can actually reduce the size of your stop loss and improve your risk to reward. So you go short on the break of this lows and set your stop loss just a distance above this highs, somewhere here, right? So this is now your stop loss distance, okay, instead of the original distance, which is much further over here. So this actually improves your risk to reward on the trade, and this is what I call the reading the price action, identifying weakness, right, and then getting a tighter stop loss on your entry. So this is one example, the Aussie dollar. Okay, let me share with you another example. Let's see what else I can find. I think Euro dollar had something similar as well. So this concept can be applied whether it's a strong trend, healthy trend, or a weak trend. So if you look at Euro dollar, okay, notice over here again, market came into this area of resistance. Of course, traders can trade this daily reversal candlestick pattern. Or alternatively, if you want a better risk to reward on your trade, you can go down to the 4-hour time frame and look for this what we call a break of structure. So again, you can see over here, at this point, right, you have a series of higher lows, and higher highs. But over here at this juncture, things have, start to change, right? The highs and lows are pretty much equal now. And the first clue that tells you that the sellers are in control when it occurs when they actually break over here. A break and close below this area of support. Okay? And again, you can just reference your stop loss, right? You can either reference it from this swing high or this swing high over here. These two levels, and again, you would have a tighter stop loss, right, compared to trading it on the daily time frame. So this is a very powerful entry technique. It involves the use of multiple time frames. Basically, right, if you are looking to short, what you're looking for is that market will be in an uptrend on the lower time frame. Then it breaks the structure. It breaks this previous swing low structure. Can then go short on the break of this swing low. Stop loss, just set it a distance away from this highs somewhere here. You can see that you have a much tighter stop loss in this case, right? And hopefully you can write the trend down lower. And on top of it, right, if you think about this, right, you are leaning against structure on the daily time frame, like this Euro dollar trade. You're leaning against the resistance over here on the daily time frame, which is this level. The Aussie dollar, you're leaning against the 50 period moving average, which is another market structure that the market has respected. Okay, so this is a additional tip for you. I believe it would really help your trading. It can be applied whether you're trading support resistance, a weak trend, a healthy trend, or even a strong trending market. If you don't believe me, let me share with you another example, just one final one. Okay, so powerful that I have to share more with you. So this is the chart of silver. Okay, if you look at this, right, 20 MA. No, sorry, 20 MA here. Daily time frame. So if you see over here again, same phenomenon, right? Strong trend rejected over here on the daily time frame. Again, you can just trade off the price rejection on the daily, but if you want a better risk to reward on your trade, you can go down to the 4-hour time frame and just look for that break of structure pattern I mentioned, which occurred over here. Notice over here, this is the 20 MA where the price bounced off. Over here, a lower high and lower low. Okay, look to go short when the price break below this lower low. Stop loss, or I just set it a distance away from this high. And you can see in this case, you have a much tighter stop loss and, a better risk to reward on your trade. Okay, so with that said, right, I have come towards the end of today's video. Just a super quick recap. Strong trend tends to respect the 20 MA, ideal to trade breakouts. Healthy trend tends to respect the 50 MA, ideal to trade the pullback towards the 50 MA or previous support and resistance. And a weak trend, the price tends to trade beyond the 50 MA, ideal to trade a pullback towards a market structure like support or resistance. Then we talk about trading breakouts, right? You want the price to be near the moving average as near as possible. If it's too far, you have to endure the pain when the pullback comes, and you don't really want that, okay? And finally, we talk about the break of structure technique, how you can go down to a lower time frame to better time your entry and get a better risk to reward on your trade. So a lot of stuff I've shared with you in this video. And really, if you want to learn more about my trading strategy, the way I trade the markets, just go down to my website, tradingwithrayner.com over here. Scroll down, right? Today we've talked a lot about trends. So if you want to complement whatever you've learned today, I recommend downloading the Ultimate Guide to Price Action Trading. We'll talk more about entries and exits, market structure, support resistance, and much more. So go ahead, download this guide, just click this blue button over here, and I'll send it to your inbox for free. Okay, so with that said, I wish you good luck and good trading. If you've enjoyed this video, do me a favor, will you? Hit the thumbs up button, subscribe to my YouTube channel. Okay, I would really appreciate it, and you'll always be updated whenever I publish such content like this. And if you have any feedback, questions, leave it in the comment section below. I will read every single one of them, and I'll do my best to help you. So with that said, I will talk to you soon.